Are your trading profits real if you never cash out? And do you need to be good at maths to succeed in trading? Well, in this episode of Systematic Shenanigans, Padma and I dive into the critical importance of realizing gains and explore whether you need mathematical skills to succeed in trading and why most retail traders struggle to compete. With our combined years of experience across crypto, futures, and equities, we break down also a recent trade involving a $12 million position and market manipulation on a decentralized exchange. This is just a conversation between two systematic traders sharing honest perspectives about risk management, market inefficiencies, and finding your edge in the highly competitive markets. Let's dive straight into episode 8. The first topic of today that I kind of wanted to go over was the importance of cashing out. I don't know if you want to talk about the trade we made, I guess it was yesterday, but there was one thing that we talked about that I wanted to bring into this podcast, which was around if you hadn't exited some of your position. I won't say the position, you say if you actually want to, back in, I think it was like January or so, you would have been down about like 50%, give or take now. And it kind of just goes to the topic of like taking out profits from your actual either trading account or positions, etc., is only when I actually classify them as profits. I think a lot of people, and especially people you see online, will say they're holding whatever, a million in their brokerage, 500K in their brokerage, 100K, etc. While that's all very impressive still, it's really impressive to make those sort of profitable trades and things like that. Until you actually have it out of your account, it's a different thing, because you never know. You could have one really bad trade, you could mess up one day, you could have crazy slippage on a trade, etc., all those sort of things. And if it's in that sort of brokerage account or something like that, then it's there's a risk being applied there. But I wanted to kind of hear your thoughts. Do you think in the same way?
Yeah, definitely. I mean, if you have those realized profits on your brokerage, okay, it's better than like everything being unrealized, right?
Yeah.
But it's definitely like the set in stone. Let's say it's when you cash out and you pay expenses, real life stuff with that. That's the goal, right? You trade to make money, to pay expenses, to grow capital, whatever. But until that capital is realized, it's just internet money.
Yeah, I couldn't agree more. This is actually one topic that's a sort of a side tangent on this, but I don't think you really need to do this in your back tests. I'm not saying this is something that's reasonable to do, but I think it's something that a lot of people miss, and especially if you're trading full time. If you're trading full time and you have like a back test, let's say that you're doing a fully compounded account, you actually technically should take into account to some extent that you're going to have to be paying expenses every one of those years, right? Like you're going to have to be taking out of your brokerage, and a lot of people don't think about that, and especially if you're not sort of accounting savvy, etc., it can be a very easy situation to be profitable in a year, but then after you have your expenses and taxes, you're maybe negative. And it's because of poor planning to some extent. So you really do need to think about those ahead of time. And I've always been lucky because I did an accounting degree. It's always like top of mind for me. But I've seen people do crazy, numbers in a year, but they've also done crazy stuff on the lifestyle. They've also forgotten to allocate for taxes. And then all of a sudden it wasn't a good year at all.
Yeah, that's funny because on my backtest infrastructure that I've built, I actually have a tax deductible at a
Wow.
certain date on the backtest. So I have that in there, and I put like 40% or 48 between those levels. It's because I want like the absolute worst possible case scenario, and then I also simulate for losses that you um, I don't know how you say in English, but that you carry forward. Okay, maybe that's the word that you carry forward for the next year. So you have to account for all of that, and I do account it. But on the realized returns at the end of the year, I always account for tax on
That's
my backtest. Yeah.
That's incredible. I'm not gonna lie. You have me completely beat on that side. I've never. It's always been mental maths for me. Just because I've kind of always known my sort of tax rate, so I'm like, oh, okay, this is the profit. Well, minus the X percentage. Boom. That's kind of like what I was assuming. But that's actually a really decent idea. Do you think it's unreasonable for most people to do that, or do you think it's a solid practice? Because I don't know where I'd stand on that.
To be honest, I don't think that you need to do it. It's not like a big requirement. How can I say it? It's like EBITDA, right? On your business. Sure, you need to know it, what you're going to pay in tax, but to actually do your business, your product, your service, whatever you are selling, to do them well, you don't need to know that. But at the business level, you need to know, okay, I'm not going to buy a Lambo by the end of the year because I have to pay taxes, right? You have those you have those people that get to the end of the year, like let's say they have $1 million in P&L. They buy a Lambo or whatever, and then suddenly the market tanks and they lose a bunch of money, but they actually owe money on the realized gains that they realized at the end of the year. Even if you lose that million in January 1st, right? You still owe the taxable income on that $1 million profit. And if you no longer have it, then what you do? Where are you going to find the money to pay that probably 300 or 400 grand on that?
Yeah, completely. This might be a completely unrelatable story, but it's just a story from some guy I know, and he bought a very outlandish car. I don't think it was a Lambo, but it was like a six-figure car, give or take, right?
Yeah.
He had made, I think it was low six figures in the year, give or take, but he just hadn't thought about the tax situation at the end of the year, and by the end of the year, he basically had to sell the car to then pay the tax. And I think it's a very common occurrence. It's a lot of times, especially if it's your first year being profitable. I would assume most people's first years being profitable isn't as insane, but maybe for some it is. You need to kind of think of those all ahead. It's gonna suck sort of the enjoyment a bit from the event. I know it did for me at least on the first year, but it's just you have to be practical. And the worst thing is having a profitable year, and then at the end of the year, after taxes, living expenses, etc., you're basically left with nothing. So no actually progress in your brokerage or savings. That can really suck. So it's good to plan ahead for those. And I think this leads into the second topic, which is I wanted to ask. I'll get your opinion first. Is do you need to be good at maths to be good at trading?
That's a good question. That's like, do you see my first note?
Yeah.
It's actually the exact same question. So there was this tweet going around last week that I commented on it even, that was saying that you as a retail trader don't have a shot at competing in this game in trading, basically, because you're competing against the best funds, and this involves like people that are really good at math, at physics, like you have the top minds in the world trying to squeeze every cent out of the market, right? And so the question is really about what kind of skills do you need and can you compete against other people? In my general, and I'll ask your opinion on it. Like my general belief is that it's kind of true. As a retail trader, it will be extremely hard to compete, but there's nuances to this, right? Like for example, you and I, we started trading small cap equities, micro cap equities, right? There
Yeah.
was a big inefficiency there because competition was lower. Big funds don't care about making $1 million or 3 million or 5 million a year or whatever. They don't care for that. It's too hard to get into it. So there's nuance. Sure, you won't be able to compete at pure math like trading forex markets. Forget it. You can't. No, your TikTok influencer is not making money there. Okay, but you can compete in other places that are less competitive, and that the large competitors that you'll face don't want to go there. And yeah, that's a more broader topic, but I'll pass it on to you. What do you think?
It's a tough topic to talk about. I'm kind of just scrolling through comments while listening to about the tweet as well, because I do think I remember he commented it to one, and that's why I was scrolling through right now just to see if I could find it, but I couldn't, unfortunately. It was about someone saying like, doesn't that sort of apply to any high performing space?
Yeah,
Athletes in NBA, any other sport, etc. And I think it does. Some people. Oh, I think I remember the comment. He was saying that like there's some natural talent there, meaning that you could be naturally inclined in those, which can increase your probability. And it's not like that's just unseen luck in trading, which is a very big difference, right? In trading, you could have your first year be an incredible year, but you could have just got lucky because it was 2020 and you longed everything, right? That's not
yeah.
necessarily skill. But I don't know. I would sit on the fence that, yeah, it's never. I sit on the fence of like, if a friend asked me today, hey, should I get into trading? I would tell him probably no. But if he is insane enough and crazy enough that he wants to and proceeds to, keep on looking into everything, and he is willing to lose money and he has accepted that fact, etc., then at the end of the day, I don't think there's anything you can really do to stop them. And I don't think it's anything that is necessarily correct to completely say never try this ever, because they could be good.
Yeah.
You never know until you've really tried, at least in my opinion. While obviously the odds are stacked against you, I think it's worth trying. And I do have, this may be egotistical, bias, whatever, but I do have the sense that the people that don't care about any of those stats, kind of like how I did when I started, are the people that win. Obviously, you already hear the undertone of survivorship bias there, but it's kind of the only way you can really think about it. I like
Yeah.
if someone had said to me, and many, like, when you see the stats online, is like Actually, back in the day, this is a good story. Back in the day, when you used to log into most brokerages in the UK, I don't know if it's the same in the US, but it would pop up and be like 99% of traders lose, or it would be like 97% of people in this brokerage lose money over 6 months. And like those
Yeah.
sort of things you'd see on a daily basis. You'd be like, damn, am I still going to trade? Am I still going to put 3,000, 2,000, whatever of your hard earned money and keep on trading? But you just have to keep on going. And I think those are the people that ultimately hopefully win. But yeah, it's still a very difficult thing to accomplish. Like in anything that's high performing, if you're going to get any alpha in any sport, event, etc., even if you're working at like Nvidia back in the early days, that's incredible amount of luck to be able to have that sort of outsized return. And that would still be like, hey, if you're going to work at 99% of startups, they're probably going to end up running out of money and you won't get that sort of big exit. But some people that worked in Nvidia did, if that makes sense.
Exactly. Yeah, and it would be highly hypocritical of me to just say, no, I did it, but you can't do it, you know?
Exactly. Yeah, I
It's
agree.
But I do agree with his general opinion that you won't be able to compete like at most markets. You are not just, you can't. And when I say compete, it's like beating the benchmark. I think we are here talking about beating like standard benchmarks. You might be able to like emulate the S&P 500 return or whatever, like a beta of 1 or close to that. But if you're going to generate alpha, something above that, it's going to be really hard competing against the top in the world. Now, there's a caveat, like we were saying. What are the markets that you are trading? What risk are you willing to take? Like our trade from yesterday, we can use that as an example, perhaps. Those are things that are so specific, so risky, but they are needed to the market, that if you are willing to go to markets where that is more risky and it's harder to do and funds don't want to compete there, you are competing against a very low tier competition. Like in crypto, I don't like saying crypto because most equities people don't like, and I don't want to like just give very specific solutions. Oh, this is the way. No, you can still compete in equities, but you have to go to equities or places where people don't, there's not a big competition and you can find your own edge there. I think that to compete in markets, you have to be very scrappy and really dig into it and fight your way in there. But it's not going to be for everyone. And it's true, 99% of people will fail, but that's like starting any business, even fitness. You will look around and there's not very much like top shape people, but all of them say they are on diets and gyms and whatever. I think it's like everything in life. It takes a special kind of person for you to be able to compete in any field. That's my view.
Yeah, no, I'd agree. I probably could talk about this topic all day because like
Me
it's
too.
something I'm quite passionate about for the reason that like any risk, this is why like people shit on quotes way too much in my opinion. I love quotes. Like Jim Simons, the basic quote is that everything has an opportunity cost, and you can apply this to everything in life. Like there is no outsized return that doesn't have some sort of opportunity cost or con, right? And like the way I view it is like trading, you don't have like business overheads, you don't have to worry about employers, you don't have to worry about any of that. You're just like focused on one thing, and that's the market in your edge. And like then you have all the other cons, right? That it's incredibly hard, you're competing against really difficult people, etc. But like if you're born 5'5", you're not going to get into NBA. It would be more impossible for you to get into NBA and become a professional basketball player than to be good at trading. I know that still is insane on stats wise, but like fundamentally it's sort of a truth to it. And I think a lot of those times, like you're saying, is you have to pick an opportunity and you have to proceed hard of it. And you probably, this is probably 1 second topic, is do you think there's a time to quit trading? Because I remember listening to Lance, and I always remember it was very interesting when I was watching his podcast that he was very advantageous around that, after 3 to 4 years, if you're not making any trading, you should probably quit and find a different like opportunity vehicle. And I never really could decide if that's true or not. I think for me, luckily I was profitable, sort of profitable after like my second year. So it kind of, that kind of compounded and I kept on going and kept on seeing things to working. But if nothing had worked for 4 years, I probably would agree that I'd probably need to find something else.
That's really a tough question,
I know.
because it's like on the third and fourth year, you are really like, if you did your work, I'm assuming someone that actually really tried, not someone that said is studying and studies like 1 or 2 hours a week. I'm not saying that. I'm saying someone that really tried. Like if you are reaching the 3 and 4th year, you are almost getting, I think you are almost getting at a place where you could be comfortable.
Yeah.
That's my experience, at least. I only got truly I only saw profits realized in my bank account in my third, going into fourth year, if I'm not mistaken, in 2020.
I'm always so terrible with the dates because trading during COVID, basically 2020 until like 2023 feels like a blur. It feels like the same year.
Yeah.
It's very weird. But actually, one last thing I wanted to talk about on this topic was that you were saying like go to scrappy areas, go to newer markets, etc. Those sort of areas where there's more inefficiencies. I do agree, but I feel like it's a good podcast that we have here because I'm kind of on the opposite side. I am slowly getting more into your realm, or I guess back in the early days, it was more inefficiencies for me with like small caps. But nowadays, I'm more, risk premiums, bit of leverage, etc. Like taking advantage of very simple concepts. And I still
Yeah.
think you can be decently profitable with that. I don't think, I definitely agree with you. You're not going to get some crazy outsized returns with this. But ironically, a lot of returns, this is debatable, but there's a lot of returns just come down to leverage in some essence, or like volatility, right? And like if you're applying a bit of leverage to risk premiums or very basic concepts, you can still make a really decent amount of money depending on how much capital you have and if you compound it over time. But yeah, you're not going to get some, 1,000%, multiple 100% returns over a year, etc.
Yeah, that is a different conversation. When I'm talking about edge, I'm talking about returns above like benchmarks, above what you get for other exposures. For example, let's say that you are trading momentum on futures, right? You are essentially still have a beta of close to 1 to that momentum factor. So yeah, you will make money, net money over long periods of time, but it's not like you are making money above that risk factor that is momentum, right? You are just how can I say, you are just modeling for momentum, and that's fine. That's an edge, a small edge, but it's explainable. It's explained by common risk factors. What I'm talking about is if you want to get outsized returns, like the stuff that really grows capital, I would say alpha, you have to go outside those type of markets, in my opinion.
Yeah, I think I would agree. I definitely would agree. And then to bring back to the fact, like the main question, which was, do you need to be good at maths to be good at trading? I think on surface level, no. But I think if you dig a bit deeper, you probably do in some essence. Because I think a lot of trading is, at least if you're being systematic around it, I think if you're being discretionary, then maybe you don't need to be as much. But end of day, trading is a probabilistic game, right? Like you do
Yeah.
need to understand a bit of statistics to actually understand it and also work around it, etc. And I would also say if you're going to like options or something, at least from my impressions, you need to be very good at maths to go
Yeah,
to options. I like a lot of people, I see a lot of YouTube videos being like, oh, there's option cool strategy, etc. But I'm like, to really be able to quantify the risk on that, you need to be good at maths, or you need to be using some good tools or something that can help. So I think you should have a basic, good understanding of maths. You don't need to be, PhD level, anything like that. But I definitely would touch up on your maths if you want to be good at trading.
Yeah, if you want to work for a firm, you definitely need to be like very good at math. But if you want to be like an independent trader and take risk, you need the basic stuff. You need probabilistic thinking, some basics. You need to be well-rounded in math, right? I have a high school diploma. All math that I've learned has been on the job. So yeah, I would say it's good to have some math, but you don't have to like figure out like the theory of relativity, right?
Yeah, I definitely would agree. All right, I guess let's move on to your second topic then, I guess, because we kind of checked off the first.
Yeah, so an update on my on that trading model that I launched last week. I think we talked about it on the call. So it has been performing quite well. I actually detected a bug today. So it is down around $200 since last week, which is normal. Market is kind of down. There's no, it's a trend model, and there hasn't been much trend either up or down, so it's normal. It has been functioning quite well, but like updating my orders, taking a bunch of trades every day because it's always updating my exposures to the current forecast and volatility. But there was a bug in the code, and this always brings me back to the idea that we talk so much since we started this podcast, right? That is, you only understand the true ramifications of your model when you put it into the market. There's no way I could find this bug on the backtest, and it was basically I was not updating as frequently as I should the model, the forecasts that it produces, and basically I was taking, for example, let's say a position went down overnight and I was asleep. I would refresh it and like update the positions myself during the day, so only in the morning, and the positions went down a lot. Okay, those positions got outsized losses, even though they should have been checked and the exposures should have matched different volatility profiles during the night. So what I did, I fixed that. I put the model now is running completely automated, and every hour it checks my exposures and checks what exposures I should have and updates it automatically. So yeah, it's a work in progress, you know, and those losses from that bug amounted to 66% of the losses that I had at the moment. So
Wow. Damn.
yeah.
So a sizable amount, I guess, of actual losses.
Yeah, I have a small account, right? I have $10,000 in that account just for testing and to
Yeah.
show people what it's like running that portfolio. I'll increase it over time, over a few months, if it performs well and there's not many bugs and stuff like that. But yeah, it's now it's just fixing it. Every week I have to see what problems come up and fix them, and over time it will like turn into a well-oiled machine.
Yeah, completely. I think a lot of people get stuck on the back testing just before deployment. I was actually talking with one trader recently, and he has a solid strategy. Like, it looks really decent. It's a solid back test, at least on front-facing value. It doesn't seem like there's anything wrong with it, but he's kind of scared to deploy it, and he keeps on wanting to like tweak it or like improve it. And I'm like, that's the kind of the worst thing you could do. Just deploy it, see how it goes, put it on a small amount of capital, put it even in sim if you want, you know, for a bit, and then put it onto a small amount of capital, and then you can make sure that all orders are going through correctly, make sure that your realistic environment assumptions were correct, etc. You can check all these kind of small bugs, and that's really the only next move after you get a basic strategy backtest. And I'm not saying basic in like manual backtesting or something, like a solid backtest. Then you just deploy it and test it, like you're kind of doing.
Yeah, we procrastinate, at least I speak for myself, on deploying stuff into the market, because if we deployed it and we are wrong, we have to reassess all of our previous assumptions, and it's very emotionally draining, and we kind of procrastinate it even if it's unconscious. So that's why I'm always saying, just go into the trenches and test it there.
Yeah, no, completely. Do you want to still touch on the diagnosing performance thing for this week?
We could actually talk just to close it off about our trade yesterday. What do you think?
Sure, let's do the trade. I don't actually know exactly my full takeaways yet. I think there's a couple basic takeaways I have, but I guess you go over the trade because it was kind of you introduced it to me, so you can go over
Yeah,
it.
sure. So Hyperliquid is a decentralized exchange on crypto, right? And they have, I'm not going to get very technical here, but just a brief overview. Like, they have a vault that handles liquidations. So when a trader runs a position, let's say that you are short $1,000 and it goes against you $1,000, or you don't have enough collateral on your account, basically this mechanism liquidates you and takes the position for them, and then hedges that position so that they are always delta neutral. It's a simple liquidation mechanism to keep things in check so that people don't run into debts, or, for example, if you have $1,000 short, let's say, and it goes 100% against you, you don't want to have like a customer with debt to you, right? So you liquidate him, you take his position out, and you take the position for yourself, and then you hedge that position with the long, and everything stays stable. Yeah. So that is the basic concept. What happened was, through manipulation, one trader got long like $12 million, something around that. And then they manipulated the market. They took funds out of the wallet, which triggered that liquidation. And the vault, the mechanism on Hyperliquid, basically had to absorb that position, forced to absorb that $12 million position. And the coin was extremely liquid, meaning that they couldn't hedge it with a long position. When I saw this, I contacted you right away because I knew that Hyperliquid had to get to remove this position or to hedge it somehow. And to hedge it, they would have to buy $12 million of this coin that was extremely liquid. It was probably trading six figures in volume, if so.
Yeah,
so
it was very low.
Extremely low. So they were going to do a mess. I contact you right away. We get long on this position, like $15,000, right? And our position was Correct. Like our idea was correct. The market started to move against Hyperliquid. They weren't doing anything. They had the risk to be liquidated. So the actual exchange getting liquidated, uh, and it was generating a massive short squeeze, and we were long from it. But yeah, through different mechanisms, what happened is that they delisted the coin from their exchange. They did some tricks on the back end and removed it there, and the trade collapsed on us, and we were kind of like late because we got slippage and everything, and we lost a bit of money. But it was an interesting trade because it was dynamic, where there was a lot of demand that was supposed to come in, and we positioned ourselves before it, and we were about to profit massively. Do you
Yeah.
want to comment?
Yeah, no, I do. I think primarily, like, it touches on the topic of that when you have these very event-driven trades, and this is the thing I find annoying about crypto sometimes. It's just like to allocate capital there quickly was difficult enough, and then to allocate it in a sense where like you had a good enough infrastructure to execute those trades easily, especially if there's like high volatility, was quite difficult. And that was ultimately our biggest flaw, is that we I think it was two candles, 1 minute candles, and it had moved down 50% since Hyperliquid took it off their site, so delisted it. And then there was also rumors that Binance, well, they ultimately did, but Binance and OKXX, I think, listed it.
Yeah.
Obviously trying to push out Hyperliquid even further, so they had to delist it straight away, and they basically liquidated the position very quickly, and that caused it was like 130% squeeze from our original like entry price. But by the time we'd executed to out, it was like we were basically breaking down a bit, because I think we averaged it a bit of a position. So the main lesson was really just infrastructure, because I think if we were able to execute at when we thought we wanted to exit, we would have exited for a really nice like tidy profit, especially of such an event-driven sort of trade. And then the only other thing was, after that whole kind of like thing happened, I basically went short on the bounce of Jelly, which was the coin. And then it was actually a really nice trade. I actually didn't hold it for long enough, which was my bad. But it was mainly I was taking the side of like kind of like short volatility in some aspects, because if you look at other coins like Melina or other very event-driven sort of coins, basically after the whole thing has happened, it just goes back to what its fair price was before the whole event, and it will slowly trade down lower. And that's basically the trade I kind of played out on it. Didn't do it perfectly, made a decent amount of money, and that was kind of like the overall summary. But I think the key lessons was really, it's hard to have capital allocated in a sense for those very unique trades. It can be so beneficial if you do, but to just keep 20K, 10K, whatever on the side that you never touch is very difficult to do, at least for us, I think. So maybe in the future, as we build our capital even further, we can, leave a 50K in like one account just for these event-driven trades, etc. And then the other side, I think, which was, as you were saying, is just take action on those sort of trade ideas. I did a very small backtest around shorting it afterwards, after the whole Melina thing, and basically that was my first like actual proper trade in a round event trade. And then also I think it was Speed really mattered on this trade a lot. If you didn't call me when you did, we probably would have missed out on like 50% gains if we had actually exited at the top.
Yeah, for sure. It's like one of those trades that it's not guaranteed that you will win, but it's pretty much guaranteed. There was no other way, unless doing some weird stuff on the back end, like it happened, but there was no other way without making a mess, like pushing the market higher. We saw that, we executed right away, and yeah, if rules were respected, we would have made a very good profit there. But it's the market, it's the live market. It never works in theory, right?
Yeah, exactly. I also think this kind of touches on the topic of if you do want to get these sort of alphas, you don't necessarily, well, I guess it's an inefficient market because it's crypto, but in essence, this still could have happened on most markets, and it would have been an event-driven trade where there's a lot of inefficiencies around it. And I think those are sort of trades that can work very well if you're looking for big inefficiencies. Obviously, they're very short-lasting, though, because they're only around an event, and that's why there's like heightened volatility around it, or whatever the price action is, and then you can take advantage of those, but they just don't come around very often. So it's a very low sample count sort of trade.
Exactly, but it is something that is very hard to do, very, very risky, because you are like, we have to go through weird on-chain like wallets and send 20K here and there through the chains and stuff like that. It's hard to do. There's not very much data, and those are the trades that are actually the highest reward at times, because it's so inefficient, and the market needs you. The market needed liquidity, and there's no one to provide it.
Yeah, exactly. Like if we were, I always like thinking about this. Like, let's say I had 8 figures right now, and I just had 7 figures to trade with or whatever. These would be the sort of trades where you could size in huge, take on a sizable amount of risk, and then make 130% in, I think it was like 40 minutes, give or take less. And that would be your year. You could have doubled your account plus more, and that'd be your year, or that would be your one kind of key event trade. And like, obviously, it's totally different to what we're trading right now, like being more systematic. But it is, in essence, a benefit of having that more capital, where you could take those very calculated 1 time, 2 time sort of trades, etc.
Yeah, and it's like I say, even on my newsletter, I'm writing about it. It's like you have your main models, those models like you said that you talked about, like normal risk premium, just momentum, trends, stuff like that, that are more stable. You know that they tend to work over time and stuff like that. They are like your base, and then if you have extra capital, you can go for these like more speculative type plays that offer really nice return profile at times, and they can really pay off. So that's the approach that I take to my portfolio.
I completely agree. It's sort of okay. I'm not going to say that 100% because I don't know 100% if that's true. I've worked with some family funds, but at least from family funds that I've worked with, it's a similar way that they have a very big allocation to very not even beta, but very stable plays, right? And then they have X amount that is basically not gambling, but it's for those very high risk opportunities that can add well, depending on your capital size, but it can add, a 5%, can add a 20% bump to your returns simply because of these one opportunities that happen during the year that you take advantage of, right? Like this year, if we had capitalized on this correctly, this would have added basically about a 10% extra return this year for me.
It would have been very nice, like a nice. It would have made like I was up over 10 grand at one point.
Yeah. In total, it was really good because it was a 130% move in like 40 minutes, which is just insane to think about.
Exactly. So next time we took a lot of lessons from there. I've set up infrastructure for next time, the correct brokers that allow us to do a bunch of technical stuff. And next time we will be better prepared because our ideas were correct and we should have gotten paid for our exposure, at least in theory. So
yeah, exactly. I think it's just you take the lessons and move on and then play on the next trade. Obviously, we may have to wait 3 months, 6 months, whatever, until the next sort of event trade like that. But it's really good to at least have it in the back because those sort of trades don't last very long and they can be, really sizable.